Hi, everyone. On behalf of HDIN Research, we are pleased to present our 2026 strategic outlook for Chandra Asri Pacific TBK. This report, titled Unleashing Transformational Growth, examines the firm's evolution from a dominant chemical player to a diversified regional powerhouse in energy and infrastructure. We begin with the executive summary. Our analysis confirms that Chandra Asri remains the bedrock of Indonesia's petrochemical industry. However, the core narrative for 2026 is the big, long, diversified strategy. By leveraging strategic M&A in Singapore and scaling infrastructure via CDI, the group is successfully stabilizing its margin profile against global cyclicality. The company's current situation. As the nation's sole producer of ethylene, styrene monomer, and butadiene, Chandra Asri enjoys a unique competitive moat. Its integrated ecosystem in Sawandan ensures a critical supply chain link for Indonesia's downstream manufacturing sector. Looking at the business architecture, we see a significant transition. While chemicals remain the primary revenue driver, infrastructure and energy now represent nearly 25% of the mix. This diversification is a deliberate move to introduce non-cyclical, annuity-style cash flows into the consolidated balance sheet. A key pillar of our assessment is the group's partnership network. Alliances with SCG Chemicals, Thai Oil, and Glencore are not merely equity arrangements. They provide essential feedstock flexibility, co-investment capital, and access to world-class R&D. Geographically, the footprint has expanded beyond the Banten hubs. With the integration of Singapore's Jurong and Bukom assets and a strategic presence in the unified markets of China and Australia, Chandra Asri has effectively transitioned into a pan-Asian operator. Now we address the complication. The global petrochemical sector is currently navigating a period of structural oversupply, largely driven by capacity expansion in East Asia. This has put significant pressure on spreads, necessitating a strategic pivot to sustain profitability. Our benchmarking on Slide 8 uses a radar analysis to compare Chandra Asri against regional peers. We observe that the group maintains a superior lead in market share and integration levels, though liquidity management remains a critical area of focus to support upcoming capital expenditures. Examining the margin trends, 2024 was a challenging year due to planned turnaround maintenance. However, as we move through 2026, we see a recovery curve as operational efficiency improvements and higher utilization rates begin to yield results. Feedstock sensitivity remains an objective risk. Since 80% of costs are tied to naphtha, the group is aggressively pursuing flexibility. The ability to switch between naphtha and LPG alongside the Thai Oil partnership serves as a primary hedge against Brent crude volatility. This leads us to the central strategic question: how can the group effectively decouple from these volatile commodity cycles to achieve a more predictable and sustainable growth trajectory? The answer lies in the three pillars of growth: inorganic expansion via the ACE acquisition, infrastructure scaling through CDI, and downstream deepening with the CAEDC project. This three-pillar approach is the foundation of the 2026 outlook. Pillar 1 is the SECP Aster integration in Singapore. This acquisition is transformational, providing the group with immediate scale in the energy and refined products market while creating massive synergy for its chemical feedstock requirements. Pillar 2 focuses on CDI. Unlike the chemical business, CDI provides stable, utility-like returns. By managing power, water, and logistics assets for major industrial estates, CDI acts as a financial stabilizer for the group during chemical market downturns. Pillar 3 is the CAEDC project. By 2027, this world-scale facility will serve the surging demand for chlor-alkali in Indonesia's mineral processing sector, particularly for nickel and alumina, facilitating a high-growth import substitution play. Financially, 2025 marked a historic surge. Revenues reached $5.1 billion United States dollars, largely due to the ACE integration. While the 2024 dip was expected due to maintenance, the recovery highlights the group's increased earnings capacity. The balance sheet remains robust, with a liquidity pool of $2.4 billion United States dollars and a debt-to-cap ratio of 46%. The group is well-positioned to fund its growth ambitions while maintaining a stable credit profile. On ESG, Chandra Asri has matured significantly. The improvement in MSCI ratings reflects a rigorous commitment to carbon pricing, circular economy initiatives such as plastic waste asphalt, and large-scale biodiversity conservation. The I-STAR cultural framework is the organizational engine. By aligning over 2,300 employees around safety and accountability, the group ensures that its complex multi-segment operations are executed with precision. Looking toward 2030, we see a three-phase evolution. First, synergy capture. Second, transition to downstream leadership. And third, becoming the leading solutions provider in Southeast Asia. In conclusion, HDIN Research views Chandra Asri as a unique structural growth story. While macro headwinds persist, the strategic shift toward infrastructure and energy significantly de-risks the portfolio, making it a compelling case for strategic accumulation. Thank you for your attention. For more granular data or bespoke research, please refer to our contact details. We now open the floor for any questions.